the extent of devaluation, loss, and hardship and turmoil that could be perpetuated, and the social unrest and the scale of this is going to make the US depression of the 30s look like a cakewalk. I think if you multiply it by 10, you universalize it through all the Western world, and you pass at least half of it on to the rest of the world for knock-on effects, you'll start to understand the economic problem. The debt markets went down, rates went up, 30-year, 10-year, go see, and we can show you those charts. But the dollar also went down. That's distress. That's distress, and that's what happened to the pound in the Liz Truss moment. And you've now had, and I said that's a microcosm at the time, America will have a similar moment. Everyone goes, no, they can just print, they can just issue. No, because there's no buyers. And when there's no buyers and people don't want, rates go up and valuations have to go down. It almost doesn't matter what yields can be because you will overshoot in a contagion of collapse. Nobody wants to hold it. It doesn't matter if you're getting paid a high interest rate, if you're not getting the capital back.
The most dangerous financial problems rarely begin with a dramatic headline. They begin when something that is supposed to be liquid, dependable, and boring starts behaving differently. Francis Hunt is making a much larger argument than simply saying stocks are expensive or government debt is too high. His warning is that the bond market itself could become the pressure point, because when governments need to borrow more, investors need to be willing to finance that borrowing. And for Americans, this isn't an abstract Wall Street problem. Treasury yields influence mortgages, corporate borrowing, government interest costs, retirement portfolios, and the price of money throughout the economy. But here's where this story gets complicated. The latest official data does not show an economy already in the kind of depression Hunt describes. The Federal Reserve says economic activity is still expanding, while the Congressional Budget Office projects historically large deficits and rising debt. So the real question isn't whether a collapse is guaranteed. It's whether the financial system is accumulating vulnerabilities that could become much more important if confidence, liquidity, or interest rates move the wrong way. And that's where Hunt's warning begins.
What they're seeing is a crowding out situation. In fact, the whole world, there's a two-tier world at the moment. And there's a certain part, the S&P 500 is dominated. We don't have a Nifty 50 anymore. We sort of have a Nifty 15, of which we have the Mag 7 in there. And we've had a crowding out. I refer to it as our twisted balloon economy. We sort of twist the balloon like the clown that does the dog for the kids. And all the air has gone into one half of the balloon. One part is called Main Street, and the other is sort of the tech Wall Street hyperscaling game. And that's where we're getting hypervaluations and excess liquidity is all gathering. But if you're running an SME and are a small business or enterprise, and you're trying to get credit for 10 grand overdraft or maybe 50 or 100, that's really hard to get. But the big unicorns borrow billions and they get access to it until recently rather well. However, recently, and I do feel that that's turning, Andy, even the big unicorns' debt instruments are being balked at now if they start to issue. Their cash generative nature and their scale no longer is impressing in terms of that part of the world, which is what's crowded the S&P out like it has. And I think we have a hypervaluation in assets. And I'll also point my favorite valuation, which I tend to usually do with charts. You can let me know if you want me to take you there, is to divide by the gold ounce. And in actual fact, we're having an everything depreciating, that we are actually having a deflation. We're having a deflation of property. We're having a deflation of most things in terms of certainly the M2 money supply and gold. If you include those two as your benchmarks, most things are actually deflating.
Yeah, that's an important point.
There's an important distinction here. Hunt isn't saying that every American business is being denied credit or that the stock market is literally disconnected from the economy. His argument is about where capital is flowing and who has access to it. And there is a reason that distinction matters. When investors concentrate heavily in a small group of large companies, the headline indexes can remain strong even while other parts of the economy feel very different. The bigger issue, however, is debt. The United States doesn't finance its government by simply printing money and walking away from a bill. It continuously issues Treasury securities that investors must be willing to buy. And that creates a feedback loop. If investors demand higher yields, the government's cost of refinancing debt rises. If borrowing costs rise faster than economic growth, more federal revenue has to go toward interest instead of other priorities. That doesn't automatically produce a financial disaster, but it creates a vulnerability. And the next question is much more important. Are we already seeing evidence of that vulnerability in the actual data?
It's such a good quality question. And there's what they tell you. So I always say we live in a duality world. There's a duality of morality, in fact. The insiders talk honestly to each other, and then they perpetuate a different narrative. Those that have just been following the Fauci revelations will know that he says one thing inside, and then he inverts it for everybody else. So in the same way, in the financial sense, we have that. They don't want to scare the herd, but behind they might be panicking. They're telling you, stay calm, carry on. So in this Besant Japanese yen story, which is current and very interesting, we clearly had a devaluing yen. And once it was past the 162 and going higher, this is a major problem. In fact, in the previous 18 months, rice, a staple obviously in Japan, had virtually doubled. And that's a debasement of currency. So no doubt they wanted to act on that. And my suspicion, and I think it was the number mooted was around 58 billion in treasuries were sought to be sold by the Japanese. And what that led to is we saw the 30-year, the 10-year, all the rates rising, in other words, the debt devaluing. And simultaneously, we also, and this hits the dollar milkshake guys really hard in the belly, the dollar was also falling. So if we're having a repatriation back to Japan, if that was the crisis, they would sell the treasury, they would convert, they would get dollars, they would convert from dollars back to yen, and we got the spike in the yen that saw the USD JPY dip down. If that was the process, it caused quite clearly a panic, and there were no doubt conversations. And what transpired is, hey, don't sell that. We can let you lend against that. And what that actually means is I become a borrower from you, Andy, even though you're holding my $1.1 trillion. And it shouldn't be that way that I have to come and beg for terms from you. It's supposed to be a liquid asset. The 1 year to 30 years is a 24 trillion market by market cap. And these guys were looking to sell 58 billion. That's kind of me looking for $58 payment on the $24,000 you owe me. And you're saying, no, you're going to bust me with that. It shouldn't happen. And this is the illusion of market cap. The debt problem actually becomes everybody who's an owner of the asset problem, including America. So whilst it's an American problem, it's also all those that hold American debts problem, which is what the Japanese are busy finding out. In short, they can't get their money back. There isn't that liquidity. And lest we forget and only talk about America, a lot of other nations, mainly first world Western nations, have perpetuated their own versions of this. So even the EU are putting out repo. I want to give you 4 examples, actually, just on this. Check out anytime you like, but you can never leave, just to drill a little harder on this. You had the Californian Teachers Association that couldn't make a payroll, and they wanted to sell quickly. Everyone like on the phone, what are you doing? Crashing the market, selling bonds. Hey, we'll let you get a lending against that. That's one of the largest pension funds in the US. She was the shortest prime minister, literally didn't make 6 weeks, along with Kwasi Kwarteng. And they wanted to do a stimulus budget to try get growth going. And that meant they were going to issue more bonds and they weren't going to pass on tax increases to try to stimulate the economy. I actually think that wasn't a bad idea, but let's just pause on that. The market balked at more issuance of gilts. What happened? Currency went down and the debt went down. And I referenced the whole dollar milkshakey thing. We win even though it's the rest of the world's problem and all of that. What we actually seen, Andy, is in the last 2 weeks, the debt markets went down, rates went up, 30-year, 10-year, go see, and we can show you those charts. But the dollar also went down. That's distress. That's distress. And you've now had, and I said that's a microcosm at the time, America will have a similar moment. Now we are having very much a smaller, not a full-blown crisis, but a little bit of a tremor, a pre-earthquake tremor. And you are seeing that in actual fact, rates going up in the Treasury market when it's in an unhealthy distress way is not leading to global funds all dying to be in bonds and treasuries. And the reason for that is the 2020 was a bond turn. In nominal terms, bonds do not go up anymore. They are no longer deemed risk-free. And we really turned the circle. You know, we jumped the shark with that CV19, and we're on the other side of the pond now. And it's a very different. And everyone goes, no, they can just print, they can just issue. No, because there's no buyers. And when there's no buyers and people don't want, rates go up and valuations have to go down. And that's the big difference.
Ready to record narration. Now we can separate the argument from the evidence. First, the evidence does confirm that the United States has a major fiscal problem, although that is very different from proving Hunt's extreme scenario. The Congressional Budget Office's February 2026 baseline projected a $1.9 trillion federal deficit for fiscal year 2026, with debt held by the public at roughly 101% of GDP. CBO also projected net interest costs of more than $1 trillion in 2026, rising substantially over the following decade. That is the part of Hunt's argument that deserves serious attention. The government is not approaching this problem from a position of low debt and negligible interest costs. But there is another side to the story. The Federal Reserve said in July that economic activity was still expanding at a solid pace, while maintaining the federal funds target range at 3.5% to 3.75%. The Fed also said inflation remained elevated relative to its 2% objective, and GDP did not show an economy already falling into depression. The BEA's advanced estimate showed real GDP growing at a 1.5% annual rate in the second quarter of 2026, following 2.1% growth in the first quarter. Consumer spending and private domestic demand were still expanding. So the evidence gives us a more complicated picture. The economy is functioning, but the government is carrying an enormous debt burden. And borrowing costs matter because existing debt has to be refinanced over time. That's where interest rates become so important. Treasury data show that 10-year and 30-year yields remained meaningfully above the Federal Reserve's short-term policy rate during July. For example, the Treasury's daily yield data put the 10-year yield around the high 3% range and the 30-year yield around 4.8% to 4.9% during much of the month. That doesn't mean Treasury buyers have disappeared. In fact, Treasury's May international capital data showed $132.2 billion of net foreign inflows across securities and banking flows, while foreign residents made substantial net purchases of long-term U.S. securities. That fact complicates Hunt's thesis. The market is not currently demonstrating a complete loss of demand for U.S. government debt. But that doesn't make the underlying issue irrelevant. It means the more realistic question is about marginal demand. How much additional debt can the government issue? At what yield? And how much higher do those yields have to go before the cost of financing begins putting increasing pressure on the broader economy? For households, the consequences would not arrive as one giant bill. They could appear gradually through mortgage rates, corporate borrowing costs, government spending priorities, asset valuations, and the purchasing power of savings. And that leads to the question Hunt is really asking. What happens if these pressures don't reverse?
I think you and I have both positioned ourselves around that. And the biggest mistake is what you have is historically, you judge your future by your history of experience. People can't conceive events so extreme and so large that there's been no precedent for it in their lifetime, and possibly even in their parents' and their grandparents' economic lifetime. So overall, I am saying that the extent of devaluation, loss, and hardship and turmoil that could be perpetuated, and the social unrest and the scale of this is going to make the US depression of the 30s look like a cakewalk. I think if you multiply it by 10, you universalize it through all the Western world, and you pass at least half of it on to the rest of the world for knock-on effects, you'll start to understand the economic problem, the reaction, and the subsequent tokenization digital world solution that's going to be uploaded on us. So from that point of view, I'm sadly dystopian, while a general optimist for my own and people around me's quality of life. I have to say, environmentally, we're probably going to go through real economic history of the ages, that for centuries they'll be wondering, what the hell were those people thinking?
Francis Hunt's forecast is intentionally extreme. He is describing an economic disruption on a scale far beyond a normal recession. The available evidence today does not establish that such an outcome is inevitable, and it would be misleading to present it that way. But dismissing the entire argument would also miss the more important point. There's a difference between predicting a collapse and identifying a system that has become more sensitive to higher borrowing costs. America's debt burden is large. The projected federal deficit is large. Interest costs are rising, and the Federal Reserve is still dealing with inflation above its long-run target. At the same time, the U.S. economy continues to grow, Treasury securities continue to attract buyers, and the financial system has not demonstrated the kind of generalized liquidity Failure Hunt describes. That distinction is critical. The most useful takeaway isn't the dollar is about to collapse. It isn't treasuries are about to fail. And it isn't even gold is guaranteed to outperform. Those are predictions. The more durable lesson is this. Debt matters most when the cost of carrying it starts changing the behavior of the entire system. That's what viewers should watch. Not one scary headline. Watch the trajectory of Treasury yields. Watch federal interest costs. Watch inflation expectations. Watch whether economic growth can keep pace with the government's borrowing requirements. And watch whether demand for U.S. government debt remains deep enough to absorb continued issuance without requiring dramatically higher compensation from investors. Those indicators won't tell us exactly what happens next, but they can tell us whether the underlying pressure is getting better or getting worse. And that is where Hunt's warning becomes useful, even if his most extreme prediction never happens. Because the biggest financial mistake isn't necessarily believing one forecast. It's failing to understand the mechanism behind a forecast. If this analysis helped you see the debt market differently, subscribe for more independent economic documentaries built around the data, not just the headlines. And here's the question I want to leave you with. If America's debt keeps growing faster than the economy, what eventually becomes the adjustment mechanism? Higher yields, higher inflation, slower spending, stronger growth, or something nobody is expecting yet?